Hello, my name is Jason Huljich, and as Head of Real Estate and Funds Management at Centuria, I'd like to welcome you to Centuria Metropolitan REIT's first half 19 results presentation. Centuria Capital Group is a specialist investment manager with $5.6 billion of assets under management. In recent years, we've been actively increasing the size and quality of our investment products to enhance our market share and identify opportunities to create value for unit holders. Real estate funds management is the largest component of the group's platform with $4.8 billion of assets under management. Centuria Capital Group has a track record of over 20 years in real estate funds management, and our vertically integrated property platform, servicing both listed and unlisted real estate businesses, remains integral to Centuria's ongoing operational activities. Included in the S&P ASX 300 index, CMA accounts for around 25% of Centuria Capital Group's total assets under management. The group's interests remain aligned with existing CMA investors as the trust's largest unit holder, having increased its stake in CMA to 24.9% in first half 19. CMA has proudly operated under the group's management structure since its IPO in December 2014. During this time, CMA has continued to expand the size and quality of its portfolio, situated in core metropolitan markets and underpinned by diverse tenants, largely concentrated amongst multinationals and government departments. During first half 19, CMA executed on a number of strategic objectives through capital transaction and active asset management initiatives. This included the acquisition of a large portfolio of assets at a discount to valuation, resulting in CMA's assets under management increasing to $1.4 billion by the end of the half. Concurrently, CMA disposed of its two industrial assets, both at a premium to book value. These initiatives have been carried out to position CMA as the largest pure-play office REIT on the ASX. Moreover, CMA has continued to focus on creating unit holder value through a number of operational and capital initiatives since its IPO, some of which have contributed to a 6.6 CAGR for net tangible assets, creating a scaled and quality portfolio of geographically diversified assets and delivering total unit holder returns of 60%. Finally, it gives me great pleasure to introduce Grant Nichols as the new fund manager for CMA. Following an extensive search, we were delighted that Grant agreed to join Centuria in this capacity. With a track record across several commercial asset classes, including Metropolitan office, Grant's experience highly aligns to CMA's strategic objectives. I would also like to thank Doug Hoskins in his role as acting fund manager for CMA. Doug's contributions have been paramount in repositioning CMA, and we look forward to him continuing to deliver strong outcomes as a fund manager in our unlisted property division. I'd like to thank you for your interest in Centuria Metropolitan REIT and now hand over to CMA's fund manager, Grant Nichols, to present the first half 19 results.
Thanks, Jason. There's been an active first half of the year for the Centuria Metropolitan REIT, with a number of transactions combining to transform CMA into Australia's largest pure-play listed office REIT. This has seen the CMA portfolio grow to 20 high-quality office assets with a combined value of $1.4 billion. These transactions were consistent with CMA's strategy of generating predictable quality income streams, as CMA has maintained high occupancy of 98.8%, enhanced its weighted average lease expiry to 4.3 years, and diversifies its tenants profile, with over 75% of the income now derived from either government, multinational or ASX listed tenants. Despite this high level of activity, CMA has delivered strong earnings and distribution returns to unit holders. Over the half year, CMA delivered 9.39 cents per unit in funds from operations, with 8.88 cents per unit paid to unit holders as a distribution. This equated to a very attractive distribution yield of 7.4% as at 31 December. CMA's debt profile has also been enhanced, with $315 million of debt either refinanced or established during the period. This has resulted in a more diversified debt maturity profile while maintaining a very competitive all-in cost of debt of 3.7%. Gearing had increased to 35.3% as at 31 December 2018, but is expected to fall back into the target gearing range of below 35% once the portfolio's last industrial property settled in January 2019. Despite the increase in gearing, CMA maintains significant ICR and LVR debt covenant headroom. The completed transactions have also benefited CMA's portfolio composition, with 89% of the portfolio now located across Australia's eastern seaboard, markets where we are seeing the strongest underlying office market fundamentals. Another benefit is a reduction in the average building age to an attractive 15.5 years. Centuria has continued to achieve strong leasing outcomes for CMA, with approximately 7% of the portfolio leased during the half year, maintaining the high total portfolio occupancy of 98.8%. These results are a testament to the strong capabilities of Centuria's in-house asset management team. Our direct tenant relationships enhance the probability of tenant renewals, enabling us to minimise downtime, further protecting revenue streams. In addition to this management capability, CMA unitholders benefit from an already robust tenancy profile, underpinned by high-quality corporate and government tenants, with approximately 60% of the lease expiries at or beyond financial year 2023. Within the portfolio value increase to $1.4 billion was a $26 million like-for-like increase in portfolio value. This valuation increase drove the increase in CMA's NTA to $2.47 as at 31 December 2018. The valuation increase was generated mainly by a $10 million increase in the independent valuation of 201 Pacific Highway, St Leonards. The increase in value at this building was instigated predominantly by the renewal of Cisco, who have renewed their 7,000 square metre tenancy for a further 5 years from August 2019. Looking at the aforementioned transactions in further detail, and in the half year to 31 December 2018, CMA completed the portfolio acquisition of 4 quality office buildings, settled on the completion of a new office development that is wholly leased to Target for 10 years, whilst disposing the 2 remaining industrial assets from the portfolio. The acquisitions, which were completed at a 3.8% discount to valuation, comprised 2 modern office buildings in the Brisbane submarket of Fortitude Valley, a high-quality office building in the Docklands precinct of Melbourne, and a share of a well-presented office building in the high-performing Sydney submarket of Chatswood. This acquisition was underpinned by a well-supported $276 million equity raising. This equity raising has increased and diversified the unitholder base, whilst the portfolio has improved asset quality, enhanced the tenant diversification, and a smooth lease expiry profile. The 2 industrial assets were both sold at a premium to book value, delivering robust IRRs under CMA's ownership. Upon completion of these transactions, CMA will have delivered on many of its FY19 priorities, particularly on transforming CMA into a pure-play office REIT, as CMA is now the largest straight office REIT listed on the Australian Stock Exchange. Given the underlying fundamentals for the Australian office markets remain robust, with positive leasing activity and falling vacancy rates evident in most major office markets across the country, CMA's scalable portfolio, now Australia's largest pure-play listed office REIT, is well positioned to benefit from investor and tenant demand alike. To that end, our focus for CMA throughout the remainder of FY19 and beyond will be continuing to build Australia's leading metropolitan office REIT, positioning CMA to take advantage of Australia's favourable office market conditions. CMA's management remains focused on generating predictable quality income streams and executing initiatives to increase the value to CMA unitholders. CMA's hands-on management is dedicated to continue leveraging our tenant relationships to benefit the occupancy and weighted average lease expiry profile of the portfolio. FY19 guidance remains unchanged, with FFO guidance of 18.7 cents per unit and distribution guidance of 17.6 cents per unit. In conclusion, I would like to thank CMA unitholders for their continued support, and we look forward to continuing to deliver value in the coming years.